Welcome back. You are watching the Oasis Focus on Finance show, bringing you an empowering approach to creating and growing your wealth. Thank you so much for your comments. The SMS line and the email address will be on screen. With me in studio today are our experts, Ebrahim Rawoot, Mansoor and Naweed Ashtiker. Our experts will be discussing wealth creation and financial planning that will put you on the path to financial freedom. Gentlemen, assalamu alaikum.
Wa alaikum salam, Shafiq.
Ebrahim, let's start off with a question that's been coming up quite frequently with our viewers, the issue of building wealth and creating financial independence. What do we say on that?
Well, Shafiq, I think there's really three concepts that we need to look at. The one is your mindset, and that is your attitude towards money and savings. The second one is the environment, or what we commonly refer to as, the economic dynamics of the financial world. And then lastly, resources and professional services, which allows you to be able to enjoy and achieve financial freedom and independence.
Tell us more about this word mindset and financial independence and building wealth.
Well, it's really an important concept, and I think everything in life starts with an attitude. That old saying, if you can dream it, you can achieve it. So you really need to believe that this is doable before even contemplating or deciding to start this financial journey. So many people really are going to start saying, but things are tough, I'm struggling to make ends meet. How would you expect me to be able to save? Well, I think really here we need to start changing the mindset, we need to start changing the attitude, and maybe adjusting a few of the lifestyle changes that we have in order to achieve these type of objectives. Now, a few things really come to mind, and I think one of those important aspects is identifying and separating the needs from the wants. Identify and say, is it a real must to have, or is it a nice to have? And then ask yourself the question, do I need to buy that big flat screen TV, or can I rather take that money and settle my debt? Does my son really need that iPhone 6, or is the phone that he's currently using good enough for him?
On the point of changing that mindset, let's consider the average man who is of opinion that he cannot afford to save 300 Rand a month, while at the same time he's spending that on entertainment on a weekly basis. By just changing his mindset, he can actually maybe entertain every second week, thus giving him that extra cash flow to actually save. And at the same time, what I always tell my client is, when saving, think of it more as an expense. Like you have to pay your rates and taxes, water, electricity, telephone account. Similarly, after doing that for 3 or 4 months, you actually become used to that saving, and you end up saving in a disciplined manner.
Attitude to debt also, Shafiq, a key point to mention. Debt is all around us, whether it be credit cards, personal loans. I mean, I get SMSs and letters coming to me all the time. So it's readily accessible and available. Now, when we decide to take on this debt, what do we do with it? And if we're true to ourselves, we know that it's basically there to fund our lifestyle. And when you take this on, we want to keep up with the Joneses, if I can use that expression. But taking on this debt comes with a certain cost. There's a finance cost to this debt. And if you actually weigh up what we are paying in finance costs versus what Mansoor said, by taking that 300 Rand away, by eliminating the debt, you actually have that surplus cash available to you. But anyways, we're now in debt, and how do we get out of it? My opinion is to list it. Because one of the biggest things about debt is actually the fear of the unknown. So by writing down your debt, by listing it all in one place, you know exactly how much debt you have and who you owe that debt to. And you can now face that debt. So you can actually console yourself now by saying, this is the worst debt that I've actually been in, because from here on in, I'm actually going to become debt free. So stay strong and keep plugging away at that debt.
Mansoor, how do we prioritize our debt repayment? I mean, this is a big thing.
Absolutely. I think one should start paying off expensive debt first. And when I say expensive debt, that's debt with very high interest rates. If we look at your credit card, unsecured loans, your RCS, and once you've managed to settle that type of debt, is try not to get caught up in that circle all over again. When we look at the credit card, my view of a credit card, it's a convenient tool in order to purchase, whether it's groceries, whatever item it is. And when I say convenient, one should use a credit card if they're in a position to be able to settle what they've used over that month when you receive your pay slip at the end of the month. If you're not able to do that, then a credit card is a dangerous tool in one's hand. Secondly, I would say look at your retail accounts, your Edgars, Woolworths, Truworths. Those type of accounts, they've also got a relatively high interest rate, Shafiq. I always say, try and form a habit that if you can't afford it, then you don't buy it. So only buy something once you buy the means, or you've got the cash beforehand to actually buy that. And then, Shafiq, largely it's obviously to settle those larger loans, car finance, your home loan. Yes, your interest rate slightly lower there, but if you are in a position to maybe put a little additional cash on top of your monthly installment that you are paying, it goes a long way in reducing the number of years that you'll actually have to settle that debt, especially if you get interest rates hikes. By putting that additional money where it helps in a period where interest rate is hiking. Similarly, if you're in a cycle where interest rates are decreasing, yes, automatically the bank's going to reduce your installment that you need to make towards that loan. You were comfortable paying X all along. The fact that interest rates decrease, you now have to pay Y. Why not just continue paying X, what you used to pay before? Again, it will shorten the time in which you're going to settle that debt, Shafiq.
Gentlemen, we've looked at mindset, listing one's debt, separating the I needs from the I wants, etc., etc. But Ebrahim, where do we go from that point to the fundamentals of creating wealth and independence?
Shafiq, an important fundamental to look at is the concept of inflation. So inflation refers to that persistent increase in the price level of goods and services over time. So when the general price levels increase, so every unit of currency or rand and cent buys you fewer goods and services. So in fact, what inflation is doing is it actually just diminishing or devaluing the purchasing power of one's wealth. So take an example of someone that has 100 rand today. He wants to fill it up with a basket of goods. So he goes to the shop and he buys himself maybe bread, eggs, milk, maybe some fruit and veg, and maybe some chicken. But fast forward today to 2020, so 5 years from now, inflation at 6%, that 100 rand in real value is now only worth 69 rand. So you go back to the store and you ask yourself, what can I buy for 69 rand today? And possibly it's only going to be bread, eggs and milk. So what inflation is really doing is it's eroding the value of one's wealth, but more importantly, it's finding it difficult to maintain the same standard and quality of living.
Shafiq, I think another fundamental to maybe unpack is volatility. A lot of people ask me, what does volatility mean? Volatility is the up and downward movement of financial markets. In industry jargon, we refer to them as bull and bear markets. A bull market is when your market's rising. A bear market is when your market's in decline. A wise man once told me that there's two things that really drives financial markets, and that's greed and fear. An example of greed would be, for the last 2 years, equity markets have performed phenomenally well. You're seeing returns of 20 plus over the last 2 years. People, herd mentality, then assume that market's going to continue doing that. They start moving out of property portfolios or cash accounts where they've got a lot of stability to that money and move into equity, not taking into account the risk in doing so. And by continually pushing money into a market that's already been running, you continually driving that market up, and that's a bull market, and that's how greed actually fuels a bull market. And then we look at fear. Fear is when equity markets are actually going down during the bear cycle, people actually concerned that it's going to continue dropping even further, and then they move out of equity markets, not remembering that when they took that investment out, it was for a long-term horizon. They took it out for a 5-year and 10-year view, but on the short-term pressure that the market's feeling, more and more of them are pulling money out of equity markets, which continues and fuels markets down even further, Shafiq.
Another important fundamental concept to take note of, Shafiq, is the effect of compounding. A short-term investment horizon usually stems from impatience for fast returns. Now, investors they overvalue the short-term payoffs and they pass up longer-term investment opportunities that is better for their longer-term wealth creation. So it's important to take a longer-term view when it comes to investing. The other aspect is also to start early. Now, what is compounding, or the effect of compounding? Compounding is generally, it's basically earning returns on returns. Now, if we can just put this into an example to maybe help the viewers understand a bit better, let's take two individuals, one aged 40, the other aged 30. They both have 100,000 Rand to invest, and let's assuming they're going to earn an average rate of return of 14%, and they're going to save till the age of 65. So investor A at age 40 has got a 25-year timeline, investor B has got a 35-year timeline, both starting with the same capital amount. Investor A at age 40, his 100,000 Rand grows to 1.1 million. By the time he's 65, whereas investor B at age 30, that same 100,000 Rand grows to 2.8 million Rand. Now that's roughly about 2.5 times more, and that's all due to the effect of compounding. So starting early and taking the long-term view actually highlights, and you can see the benefit of compounding coming through.
You're watching the Oasis Focus and Finance show, bringing you an empowering approach to wealth creation. Take a quick break. We'll be back after this.